Alrighty, folks, it's time to talk housing 2026. It'll be interesting to have this conversation with Jason Hartman because there's been a lot of bearish takes. Some of the Jerry Springers of housing analysts have called for a 50% housing crash in 2026. Others have called for double-digit housing crash in 2026. And I think there's actually a lot of undercover good news or positive momentum. But heck, let's talk to Jason Hartman. He is the man. How you doing, sir?
Good, Michael. Good to see you. As always, I love doing this with you every week, and I'm getting a lot of positive comments from a lot of both of our followers that say they love these updates. And, the doomers just continue to be these armchair quarterbacks that have no real frameworks, no real data. They pick out one little data point, pluck it out of the air and say, oh my God, the sky is falling. And they just keep being wrong over and over again. And they are causing people to lose, hundreds of billions of dollars because those people keep missing out by listening to these people. It's just unbelievable.
Folks, at the end of this, it is absolutely, it's pure evil. I've tried to tell people for years not to follow them, to block them. I now call them Jerry Springer, right? I know Jerry Springer is kind of for our age group, maybe Gen Z or Gen Alpha doesn't know who he is, but go Google him. And his show, the only person that got rich watching Jerry Springer was Jerry Springer.
Absolutely.
And that's the same thing today. These content creators aren't making anybody rich. In fact, they're causing them great pain and great opportunity costs. And they never see the big picture, right? They point at something or worse, they just have PTSD.
Yeah.
Some of them went through the GFC and lost property, right? They were in the mortgage business. They lost their job. They lost their home and they've never forgotten it, right? Others worked it during the GFC and saw lots of pain. And thus every housing market has to be the GFC. And that's just not how it works. I've studied housing all the way back to 1970. And these people are blinded. They're either blinded or evil, right? I'll let the audience pick which one they are.
Yeah,
because we're not in the GFC.
One thing I want to say about the global financial crisis, otherwise known as the Great Recession, the worst economy in over 7 decades, right? Can you imagine people living through the Great Depression in the 1930s and thinking the next 75 years, they keep saying, oh, we're on the verge of the Great Depression again. It's a repeat. And they miss an entire lifetime of opportunity. They miss the 50s, the boom times, the 60s and all the modern discoveries in aviation, space travel, lasers, a million other things, right? All of these incredible opportunities. They miss these opportunities over and over again because their mind kept saying, oh, the Great Depression is going to repeat itself, right? Yeah. It's going to repeat itself. And that's exactly what people are doing with 2007, 2008, the Great Recession, which wasn't, of course, as bad as the Great Depression. I would actually argue that, like, when you were saying that a lot of people lost their houses and so forth, and we all know the story, anybody listening to this was, surely alive back then. And we know the story, but I would actually argue that we should view this in another way, because most of the people who went into foreclosure and lost their houses got the advantage of living in a house that they never really deserved to live in the first place, okay? Because their loans were underwritten carelessly, and they shouldn't have been able to qualify for that house. But do they appreciate this at all? No. They say, oh, the bank took my house. Well, you got the lifestyle benefit of living in a house that was much greater than you should have been allowed to live in for a period of a few years, and you got to live there for free for part of that time because you didn't make your payments, and the lender was entering into the process of foreclosing on you, and maybe you ultimately got a loan modification, which is a free perk. Maybe you ultimately got a short sale, which was a benefit to you, right? People just look at this the wrong way. And I'm not saying that happened to everybody, okay? Some people just, it was not a good experience. It was a tragic event. Okay. But millions of people got to live in something they didn't deserve. It would be like, if you drive a Toyota Camry, which by the way is a great car. Okay. If you drive a Toyota Camry and then someone gives you a Rolls Royce or a Ferrari and you get to drive it for free for 2 or 3 years and then they take it back. And your attitude is like a spoiled child. Hey, I want my Rolls Royce. I want my Ferrari. You never deserved the Rolls Royce or the Ferrari in the first place. Okay. You got the benefit of it for a period of time for free. Okay. Like this is just not as it seems. I know people that lived in their luxury homes that were much higher than the lifestyle they could afford or ever had in their life for years for free. They got to live there for free. It was actually a benefit to them. But the viewpoint is, it got taken away. Well, you never should have had it in the first place. Okay?
Yeah, I think a lot of people don't put, 1 and 2 together kind of as like that, because you're absolutely right. And I've told people for years, the hardest year to be a landlord was 2006, not 2008. It was 2006. Why? Because
everybody was buying.
I routinely decline people to rent because of poor credit or poor income. And they bought a home.
Yeah. Right.
That's not, believe me, if I'm going to turn down a tenant for income or credit, they probably shouldn't be able to buy a home.
Right.
But they did it all the time.
Let them rent a home. Right.
Exactly. I would keep it vacant before I would rent. So again, there was lots of unqualified people getting loans. There were, if you guys don't know, there were dogs getting loans. It was just a very, very bad
there were
environment.
People getting loans.
Yeah, it was crazy. Babies
just
getting
like
loans.
People voting in the elections.
Anyway, but again, I think a lot of people do have PTSD because it's like the most recent memory.
Yeah.
And that's very dangerous. When you study economics and history and money and finance, you've got to go back farther than a decade, people, right? You've got to go back 50 years, 100 years, because we don't have the recipe. In fact, I will tell you that the setup for 2026 is a hell of a lot more bullish than bearish. And that's your Jerry Springer housing analyst with 50% housing crash. They're going to be wrong again. They were wrong last year. They were wrong the year before. And they're only saying these things because they pay their rent creating BS content.
Yeah.
Yeah. So I heard you had some slides for us. You want to take a look?
Sure. Yeah. Here's more stuff that is bullish. Well, all of these bears, all of these doomers, all of these chicken littles saying the sky is falling. Here is the actual data. Okay. This is data. This is not, this is not opinion. Nick Gurley's dumb opinion that is just misleading everybody, right?
Yeah.
This is from this morning. It's from the Calculated Risk newsletter by Bill McBride. He had a couple of great charts in there and a couple of great things. Mortgage delinquencies decreased again. Okay.
How can that be? We have housing analysts saying that the delinquencies are increasing, that foreclosures are going to skyrocket. Q2, I've been told Q2, the market's going to end, Jason. How can this be?
Yeah, sure. We live in a world where there are no gatekeepers, and that's good in many, many ways. It used to be that you had to get through a whole bunch of hurdles and a whole bunch of doors slammed in your face to get on the news and spread whatever you wanted to spread, whatever news it was, right? And nowadays, just anybody with a computer or a phone can jump online and publish their stuff. And sadly, people listen to them. They have no actual qualifications. They have no actual experience, and they have no actual data, and they have no models. They have no frameworks. They just have an opinion to get clicks and make you click on their sensational news. Okay, this is the real data. So let's just look at the history here of this chart. And we see, talking about the GFC, the Great Recession, 2007, 2008, right? We see how high delinquencies were back then, and we see where they are now. And right now, it is a nothing burger I mean, it's just a nothing burger. It's like we got this entire country of 342 million people, 140 million housing units, and 17 of them are in foreclosure. I'm joking, by the way.
Yeah.
It's higher than that. But I'm
Yeah.
just saying it's just nothing. It's a statistical.
It's below trend. It's below trend.
I know.
It's below the average of 2000 to 2005. I mean, it's.
And this, by the way, is from the ICE Mortgage Monitor. Okay, they have been collecting data for years. There's no agenda. This is just data, folks. It's just real data. So let's look at another one, okay? The rates have dropped over the last few months, right? And this is, again, from that same newsletter. Rate and term refinances dominated activity as borrowers move back in the money. So this means people who are simply reducing their mortgage payment by about $200 on average, okay? Rate and term refinances, in other words, not cash out refis.
Right.
Okay. This is just, let's get a lower rate and let's make our debt service less of a burden.
Correct.
Not more of a burden. These people are getting more comfortable.
Yeah. Discretionary income goes up by $200.
Exactly. So this accounted for 62% of all refinance activity in October. Okay, and that's the most recent data, by the way. Highest share in nearly 5 years. An estimated 95% of rate and term finances in September and October involved loans made over the last 3 years, basically, okay? On average, the refinancer is carrying a loan balance of $505,000 and a credit score of 762, which, just so you know, is a very high credit score.
Yeah,
these people are super responsible borrowers. Anything above 720 is pretty darn good.
Yeah.
Okay. So this is not low credit score, unqualified people. These are very good quality borrowers.
Well, they're financially prudent, right? Because again, they could take cash out, probably not a lot, but some, and they're deciding not to. They're like, no, I'm going to lower my monthly nut by, in this case, an average of $200, which means I can take that 200 and do whatever the hell I want with it. Exactly. These are financially responsible people. Yep.
I can invest that money. I could spend it on my lifestyle, whatever. But as we've talked about before, Michael, the one ingredient you must have to have a housing crash, the one mandatory ingredient without which you cannot have a housing crash, is tens of millions of desperate, distressed homeowners that become millions of desperate, distressed home sellers. And what we're seeing here is the exact opposite of that. Their delinquency rates are down. Their payments are getting lower, not higher. Okay. Their credit scores are super high. These are just solid refinance loans being made. And to add to that, home affordability is at its best level in nearly 3 years. It does remain stretched. Homes are expensive. We all know that. But that's only for new people coming into the market.
Correct.
It's not for existing homeowners who are very, very comfortable and not in distress at all.
Yeah, this home affordability, the best in 3 years, it's something I talked about way back at Jackson Hole meeting when Jerome Powell said that there shall be pain and rates doubled. I told people that, affordability is going to get stretched. And unfortunately, no matter what Nick Gurley or Melody Wright or, real estate mindset guy says, this is going to take
or
five,
or
Sachs or any of these people, these Jerry Springers of the world. It's going to take 5 to 8 years of just sideways grinding. However, slightly lower rates. And by the way, we've had 29 months, soon to be 30 months in a row of wage growth above home price growth.
Great point. Wages are growing faster than prices. That means
it will continue. Yes.
That means people are getting ahead, not behind. They're getting better. Their financial life is better. It's more solid. It's just keeps getting better, and nobody appreciates it.
Because it's sideways and slow, right? Yeah. It's not the fast run. It's not the dramatic 50% crash or the 28% crash or whatever the number they pick out of their ass.
Yeah.
The other thing I think is really interesting, and I don't know if you picked this up, but I think Logan from Housing Wire pointed this out.
He's one of the good ones.
Yeah, he's a good one. We just pointed out that we had the highest mortgage applications to purchase of the year.
I saw that. Yeah.
In November. What are we doing? Do people not realize what's going on? This is a lot of positive momentum for 2026.
Yeah, and those mortgage remember, folks, the mortgage applications index, right? All the stats on that are segmented by, were they purchase applications, were they refinance applications, and if so, in the refinance category, like we talked about earlier, were they rate and term or cash out refis? Okay, and so most of them are rate and term. Purchase applications are higher, not lower. People are feeling good. They're optimistic. They're buying houses at the highest level in almost 3 years. Yeah, it's just what Michael said.
Yeah, the other thing that I think is interesting is we've had record delistings.
Yes, right? That is interesting.
Yeah, delistings are up 28% year on year. But again, you have to step back and ask yourself a couple of questions, because I think a lot of people just assume that these delistings will come back in the spring. And undoubtedly, a large percent will. However, folks, what you're missing is some of these people are going to become accidental landlords.
Yeah.
Right? They couldn't sell for what they wanted.
Right.
Whether the price was right or wrong doesn't matter. It didn't sell. But now they're going to go, you know what? I got a 2% mortgage. My mortgage payment's $700. I could rent it for $2,000.
Exactly.
I'm just going to make it a rental. And we're going to see a lot of that.
Yeah, the delistings. Okay, so what is a delisting? It's someone who put their home on the market and they stuck to their guns on their price because they're just not that motivated.
Exactly.
So they decided, my house isn't selling for the price I want. I don't care. I'm going to just pull it off the market and I'll do it later, maybe, or maybe I'll just rent it or keep it as a second home. It's so affordable. I'm not under any pressure, so I'm just going to take it off the market. Now, the real estate agents hate this because, they
spent money. Yeah.
Their listing never sold, right? But delistings are actually a positive trend for real estate, because what it means is that the seller's expectation is up here and they're not budging. They're just sitting tight because they're comfortable. So it's the delistings is actually a really interesting trend, and they can just wait. And I'll tell you, I have the same problem on my own personal residence search. I talked about it on my podcast and YouTube channel. There's this house that I've been keeping an eye on for, many months now. And I made 2 offers on it. It was originally listed for like $4.4 million. It's in the Arizona, Phoenix metro area. I really like this house. It's in very nice condition, but listen to this. It's been vacant the whole time for at least many, many months. The husband passed away. So now the wife owns the property completely. She moved out. And, that house, to hold that house has got to be costing her in terms of maintenance, property taxes, association fees, and opportunity cost. I don't know. I can't remember if she had a mortgage or not, or if it's a low balance or whatever, but opportunity cost on that money, that's got to be costing her at least $25,000, $30,000 a month to hold that house.
At least. Yeah.
And she's just kind of like, the agent reached out to me about a month ago and said, hey, can we do something on this property? And I said, look, man, I'm at like 3.6, 3.8. That's my number. And, she still wants, like $4 million. We just can't come together.
Yeah. Well, the good news is I've been doing real estate a long time, and the longer you stay to your guns at 3.6 to 3.8, you're gonna end up with that house, if that's the house you want. No, you will. Positive thinking, Jason.
Well, let me tell you something. Look, Jerome Powell's on his way out. He's under massive pressure to cut rates. And if we see mortgage rates come down, and then we're into like late January, after people do their, they get their 1099s, they start thinking about their tax picture, they want a write-off. And real estate is the most tax-favored asset class in America. And it's the most historically proven asset class in the entire world. we see rates tick down a little bit, that house might get gobbled up. I've seen it many times before. We'll see.
That's right. I believe in positive affirmation. So Jason, you will get that property. You're going to lock it up at the end of the December. So I'll just put it out there for you. Jason, you do a lot of amazing stuff. You're coming out to the Vegas event in February, which we appreciate. Keynoting day one. I appreciate that.
Remember, income property is the most historically proven asset class in the entire world. And Michael, keep doing what you're doing. It's great. You're telling the truth. You're telling it like it is, while all of these crazy people out there who are saying, they're just lying to get clicks and sensationalism and fear-monger people. It's just not factual. So I really appreciate what you're doing, and happy investing to everybody.
Folks, at the end of the day, if you're watching Jerry Springer, remember, the only person getting rich is Jerry Springer.
Yeah.
Later, bud.